a quick conversation. I'm doing that special webinar on how to repair stock positions using option strategies. I'm going to do a shameless plug. You can just go to bigpicturetrading.com and register. We're doing it on Tuesday, the 18th. But the idea behind it is that while there are these violent drops in the market, there are also going to be violent rallies. And, I'm going to use Tesla as an example. But let's say somebody bought Tesla thinking it was a bottom at $300 a week or two ago. And they find themselves suddenly, the stock goes and drops a further $80 to the downside in a span of a week, right? And you find yourself offside. Well, the thing is that how can you repair the trade to try to improve the level from which you can get out of this trade at a lower price point, a lower break even to get out of the trade? And like one of the popular ways of executing that is, let's say, for instance, doing a ratio call spread. And as an example, let's say right now Tesla's at 250. I was just looking at the live market price. If you, let's say, went and bought another call option at 250, right at the money, it was somewhere near $20, and the 275s were all trading for about $10, but you would sell twice as many of the short calls above because your original stock is covering the one call, and the second call is like a debit spread covering the credit from the others. So you basically, it cost you nothing to open the ratio spread. It was $20 in, $20 out to open it. But if you originally purchased Tesla at 300, your break even on the exit is at 275. You literally have allowed yourself that, I'm going to put on like an hourly chart. If you just simply had Tesla make one quick little pop up here to 275, you could near expiration get out of this trade at even. Right. And the point being is that you didn't need the stock to rally to $300 and to get back out at your break even price. And so there's these option strategies that are really important. And why is this something I highly endorse? Well, what's the most common way most people repair trades? Dollar cost average.
Right.
Right. The problem is that if you go and double the amount of money that you put into Tesla, let's say you had 1,000 shares and you go buy a second 1,000.
Oh, I like
Well,
it. Your clients are obviously shooters.
yeah, but let's say you had 1,000, you go and slam in with another 1,000.
Yep.
Now, if this thing was just a flagging formation, it drops to 200 or 180, you're losing now at twice the pace, and the pain is becoming twice as hard. And you took really good, nice, clean money and you threw it after a bad trade and making the whole thing a big hot mess, right? But with this spread strategy, if Tesla keeps going down, well, the call options, you paid nothing for them and they just expire off there and you're just stuck with your original shares. You didn't double down. You didn't increase your risk to the downside. And so it's one of the tools in your toolbox that you should know how to fix things. And, very few people understand it. I'm going to just do a great webinar explaining it in greater detail. And anyone who wants to join is completely free.